Maybe I'll start with the second part of that question. I'm not entirely sure that it has a bad reputation, but what I do think is that intense economic circumstances, sometimes finger pointing takes place, and there's no question that with the economic upheaval we saw beginning at the end of 2008, finger pointing did take place, and sometimes it was directed, amongst other places, at speculation in markets. But I think that there's probably a greater appreciation of the broad role played and how hard it is to really define speculation. And I think that it's important to keep in mind that for people in industry, people that are in commodity markets as in the physical side, as producers or distributors or refiners of it and the processors of it, they have to make decisions all the time about what they're going to do in the future. Fundamental decisions such as, will I sell at a price in the future that I know today, or will I wait till the future to see what the price is then? Either choice they make there, they're taking on risk. And in some ways, even though I'm not calling them speculators or calling that speculation, it's very similar to speculation. And to accommodate that, there are other people that are willing to take the other side of that risk and to hold that risk. And that's what goes on in markets. And I don't think anybody has ever seen that as being negative or a bad side. So I think you need to look at it very broadly. And the way the markets work is they help those that are willing to take on risk, who are sometimes called the speculators, balance things with those that are that need to either somehow manage their risk or to adjust it accordingly. Okay, and both of those. To start with, I don't think financial speculation had any material impact on the real price of commodities, and especially not of oil. It's very easy at times, as I said, when people are, if things are tense economically, to look for quick kind of explanations for things, but they don't really hold up. The financial markets can't really lead where the physical markets go, because even where they tend to meet, which are in public marketplaces that are very transparent and subject to public regulation, those markets are set up so that the underlying product converges precisely with the underlying physical market. And that's a very important characteristic. So, for instance, the CME Group's NYMEX markets, where physical delivery is the terminating obligation, you can't tell the difference between that terminating obligation and anything else that goes on in the physical market. But if financial markets for any moment didn't reflect what was going on in the physical market, it would be arbitraged immediately for profit by people that are in both markets, which means the physical market. So they're set up so that that type of convergence happens instantaneously and at all times. And that's why financial markets can't really lead the physical. If they were somehow independent of what was going on in the physical markets, they would not be relevant to the physical markets. They'd serve no useful economic purpose, and nobody would use them. They would be completely detached, and it wouldn't matter what they do. But that convergence and arbitrage that keeps the convergence together ensures that it's the physical market that dominates price determination. I think that since I represent an exchange, I always have to recuse myself from making any comments specifically on price levels and where they may go, because exchanges don't have opinions on that. But what I can say about today and earlier in the decade, including 2008 and even earlier than that, is that we've seen the underlying futures markets and commodity markets become more and more liquid and more diverse in both the numbers of participants that use them and the types of products they offer. and they offer such a wide array of vehicles to help people in the physical market transfer the risk to those that are professional risk managers, as well as investors that may well see opportunity in balancing their portfolios. These changes are always happening in the market and growing, but they're beneficial. And because these markets are transparent, we're seeing much more of the obligations that underlie the physical, the financial, and the investing markets become more transparent. And also, these markets are well managed financially, so that parties that have positions in these markets are not subject to counterparty credit risk. And that's a very important role. So we're seeing much more of the balance sheet of obligations of parties shift to being well managed from that financial perspective and counterparty credit risk perspective. So this is ongoing and will continue, I think, to grow in the market. But I think it reflects overall efficiency, and that's why I think it's growing. It's true. I don't think even oil is really a special case. I think commodity markets have many similarities, and they have some differences at times. Oil is more evolved than many physical commodity markets, but that reflects its importance in the world economy and just many different factors that are important in the oil market that are perhaps not so manifest, at least not yet, in other markets. One of the things that seems to have happened, and this is with relationship to price relationships along what we call the forward curve. So for near-term prices, such as next month being earlier in the curve, and for further out prices, saying 5 months, 12 months, or even 3 or 4 years out, we've seen perhaps some change in the relationship in that curve. It used to be that the prices, when the nearer term prices changed, the entire curve might change in sync with it. Some people have pointed this out, some analysts. This is going back to even earlier than the decade that we just left, and into the early part of that decade, so into the early part of this century. But since that time, as these markets have become even more and more integrated with others and serving additional purposes, we're now seeing that at times the nearer term prices may change, but those further out may not change as much. Now, I'm not predicting that will be the case, but I'm interpreting that we're now seeing different types of obligations being managed in these markets further out in time. Keep in mind that anybody that uses the financial markets, it's voluntary. But all the price information there is transparent. So we don't know what is happening outside of those markets, especially as we go off further and further in time, because the forces of arbitrage really are much more influential in the nearer term when delivery obligations have to be met. They're always operating. No one would ever leave a profit-making opportunity undisturbed if they perceived it anywhere, even if it was for obligations 3 or 4 years out. But when the delivery obligation is closer in time, it does put the pressure on that arbitrage. It increases the pressure on that arbitrage, and I think more arbitrage does take place in the nearer term.